Good evening, everyone. I welcome you all once again for our sessions on revision. And today, the topic that we are revising, as you all can see, is the topic on clubbing of income, topic on carry forward and set off. So I'm sure you all are well versed with this topic, firstly. So it will cover some part of deduction, some part of clubbing. Now, wherever you feel that, sir, we are not able to recall, you want something from my side to be taken care of. As far as revision of the provision is concerned, you can let me know. We will go to that particular topic's revision. And as usual, I'll request you all to be live, to be regularly responding, to be raising your queries and doubts, because that is how it will help you understand and absorb the maximum out of this revisionary class. So clubbing, set off, and deduction. These are the three topics that we will revise cumulatively. Again, as in the previous class, I've shared some question on the screen. You all should take a screenshot, but not of the first one because it is already done. But all further questions, you will be taking a screenshot so that in the time I am explaining you or I'm discussing with you the question or the provisions, you can at your end do the revision from the notes and give me the answer. Now, why I said not the first one, because if you remember the previous class, this question was already done in the previous class. It deals with the topic of other sources plus deduction combined. Hence, it was already done where Mr. Vivek had taken a life insurance policy after the date which is mentioned in the provision. So both policies are taken after the date, and the policies are for sum assured of this much, where the premium is not exceeding 10%. So it is satisfying one of your criteria that the premium should not exceed 10%. But the cumulative premium of both the policies is exceeding 5 lakhs, though individually it is not exceeding. Now, here the question was, in the year in which this policy matures, what would be the tax treatment? So we had analyzed the provision in the previous class, if you all remember. And through that, we had come to the conclusion that both are eligible for exemption, but the law says any one can be taken as exemption. So why not take exemption of the policy, which is giving me higher returns, so that to that amount, my amount will get exempt. Hence, we concluded that policy A will be exempt and B will continue to be taxable. Now we move on to the second question. Now here I want you all to read this question so that you all are able to understand and answer this. Now, if you remember, I had also given you an approach how to handle the questions. So where the question is a MCQ type of question or a case scenario question, you should first read the question and then read the case. But here, this is a computational question where you are required to find out the final taxable amount. Hence, here you will read the question first. So I'm just making the question visible on the screen so that in case you want to take a screenshot first, you can just take a screenshot for your reference. Correct? So maybe here now you can take a screenshot of this. This will be shared with you in due course. So please take a screenshot and I give you 5 minutes to read the question. Let us read this together. Yes, good evening, everyone. So, good evening, Lokesh. Good evening, Golika. Good evening, everyone present. So, Mr. K is 48-year-old. So, he is not a senior citizen, though he is a resident. We are dealing with details for the previous year 24-25. So, the assessment year 25-26. Fine. Now, he has two businesses. Manufacturing business showing profit of 10, speculative business showing loss of 7. Now, students, I'm sure you all know this or you all can help me with this, that whether the loss of a speculative business can be set off against a regular business. You have to say yes or no. You can write Y or N. Only one answer. Whether the loss of speculative business be set off against regular business. Okay, good. Very good. So perfect answers by everyone that no, it cannot be set off. And further, Lokesh has added one more point. It can be set off, but only against income of similar nature, that is speculative business. So since there is no speculative income for the time being, we will carry forward this loss. Now tell me, to what period can a loss of this nature be carried forward? And also, if possible, tell me the section number of carry forward. Chalo. See, I'm giving you time. You can refer module. I also have it on the screen, but I'm just trying to avoid switching the screens. So in case, okay, one answer, two answers, very good. Can anybody help me with section number? Okay, Lokesh, please reconfirm. Kushi, very good, beta. So the correct answer is this loss can be carried forward for 4 years, and in all the future 4 years, you can set it off, but only against income from same line of business, which in this case would be speculative, no other income. And yes, very correctly mentioned by Khushi, by Gulika, that it can be carried forward for a period of 4 years, and it is as per section 73. Perfect. So let us proceed. So first thing is clear that as far as this part is concerned, I am not able to set off this amount. So I'll have to carry forward it. So my PGBP is in the nature of 10 lakhs, which will be the final amount. And in this particular case, I am not going to set off this 7 lakhs. So the PGBP nature or the regular business income will be taxable, and this will go to the next year. Then there is another detail. I incurred a loss of 215 from a let out property, and at the same time earned an income of 50,000 from activity of owning, maintaining racehorses. For earning this, I have spent rupees 5,000. So one by one, this loss, can I carry forward? Can I set off? What is the possibility? Firstly, this is a HP loss. What is this possibility? Chalo, waiting for your inputs. What is the possibility of setting off this loss? Can I set off? Can I carry forward? Is there a limit? Is there a condition? Anybody? Okay. Lokesh is saying, sir, maximum 2 lakhs can be set off. Okay. HP can be set off with other heads up to 2 lakhs. So this is Lokesh, I want to know whether within the same head HP you are saying 2 lakhs or whether you are saying 2 lakhs with other heads. This is very important. Kushi says, sir, HP can be set off with other heads up to 2 lakhs and carry forward the balance for 8 years. Very good. Lokesh says carry forward for 8 years. So Lokesh, are you saying, Achha, so you have connected answer. But Lokesh, then my question is this 2 lakhs limit within HP head also? That is, if let us say I have 2 HP income. See, now we are revising, even though there is no such income yet. I don't know whether it will come in further adjustment, but just since we are revising, so I'm parallelly revising the entire provision. So my question to everyone is that this 2 lakhs limit of setting off, whether that limit is within HP head or HP head with other heads. What is the exact criteria? I'm sure you understand what is the relevance of this. House property loss can be set off against HP in 115 BAC in optional up to 2 lakhs with other income heads also. Okay, Gulika has given me some inputs, but others inputs I have not received. So in case you all have any doubts, let us revise. See, because this is an important point. So it is very important that you are clear with the provisions. So I'm sure there are students who are giving the current attempt. So you have done this chapter. So if I'm directly going to the provision, it would be easy. I need not go to all basics. So there are two sections, 70 and 71, which deals with carry forward and sorry, not carry forward, which deals with setting off under the same head first, that is 70, and 71 is setting off with other heads. And then you have sections from 71 onwards after 71, which deals with carry forward. Now in this, we are right now only concerned with HP head. Now for HP head, see what is the provision. The loss under the head income from house property would not be allowed to be set off against income under other heads if assessee is paying tax as per the default scheme or the new scheme. However, if the assessee exercises the option of shifting out of the default scheme, that is going back to the old scheme, then there is a loss under the head house property. The assessee has income assessable under any other head. The maximum loss from house property which the assessee will be able to set off from any other head is 2 lakhs. In other words, in such case, the amount of loss exceeding 2 lakhs would not be allowed to be set off against income under other heads. So firstly, is there a restriction under the same head, both new scheme, old scheme? So see, for same head adjustment, you have section 70, which talks about adjustment within the same head between different sources under the same head. Now in this, what are the restrictions? There is a restriction for long term. There is a restriction for speculation. There is a restriction for activity of owning, and there is a restriction for specified business, that is 35 AD business losses. But there is no restriction for HP. So it means within the same head, irrespective of the scheme, the HP loss can be set off. I hope this is clear with all. So irrespective of your scheme, old scheme or new scheme, within the same head, HP loss is easily set offable. But when it comes to setting off with other heads, you have to check for the scheme whether the question is talking about any particular scheme. If not, As the rule of the law says, if nothing is mentioned, you have to presume that it is the default scheme, which is the new scheme. Now, we will see what the question says, but since we are revising, I'm not only focusing on what is given in the question, so that I'm revising the whole provision. So here, with relation to inter-head adjustment, that is adjustment between different heads for HP loss, what it says, the loss under the head HP would not be allowed to be set off against income under any other head if the assessee pays tax at concessional rate under 115 BAC, that is the optional scheme. So if you're under the not optional scheme, I'm sorry, under the default scheme, that is a new scheme. So if assessee is under the new scheme, in that particular case, no set off allowed against other heads. Same head, no restriction. We are only talking about other head adjustment. Then it says, however, if the assessee exercises the option of shifting out of the default regime under this section and there is a loss under the head house property, assessee has income under other heads, the maximum loss of house property which can be set off from other heads will be 2 lakhs. Correct? So I think Gulika had given this answer first. Yes, so Gulika had already given this answer. Others' answers were also correct. So Gulika had specified this, the house property loss can be set off against HP under the new scheme. In optional scheme, 2 lakhs against other income heads also. Correct. So now, since you have understood the provision, we have done a revision of the whole provision. Now, I have a loss. So I'll just write over here HP loss. And I'll just go to check what scheme is given. If not, we'll go by the default scheme, which is the new scheme. So what it says, Mr. K, assuming he exercises the option of shifting out. So it means you are in the old scheme. So if you are in the old scheme, one thing is for sure, up to 2 lakhs, we will set off against other heads if required, and balance 15,000 compulsory carry forward. Correct? Fine with all students? Can we proceed? See, wherever you find any issue, any doubts, you tell me. If something is to be explained, I'll explain. If we have to go back and check the provision for revision, we will revise. No problem. See, I don't expect that everything should be learned by you, but at least understanding wise, the understanding should be clear. If learning is by chance not completed by now, no problem. Refer the provisions from your module. It is very fine. Okay. So now I come back. Now there is one more income mentioned in this para, that is income from activity of owning and maintaining race horses. So this income is taxable under the head other sources. I'm sure you all know about this. And this income under the head other sources would be computed as 45,000. Fine. So this is PGBP, this is OS. Now he has earned STCG, okay, 50,000 from equity shares sold on this, on which STT is paid. What is the impact if it is given like this? STT is paid, something like this. What will be the impact, students, of this? What is the impact of this, students? Recall, no problem. We have to revise the provisions. So I'm ready to wait. You can refer module, no problem at all, because at least through this, you will be able to revise and connect. And most importantly, many times we revise chapter wise, but now in a comprehensive setup also, you should be able to connect. So no problem. Go back to the provision. What is the impact if it is given in the question that the gain arises from sale of equity shares and on which STT is paid? Any special impact of this? Any special treatment of this? Okay. Good, Shri. So anything else you recall? You are correct. So I'll mention what it is just to save time. Yes, Gulika, you're right. We also have to check the dates. So whenever it is a transaction of equity shares or units of equity oriented funds, and it is given that STT is paid, then short-term capital gain will get covered under the special provision of 111A. And had this been long term, it would have got covered under the special provision of 112A. And as you all rightly pointed out, I think Gulika pointed out. So, what is the effect of this? So, if it is a short term capital gain, it will not come under the regular slab rates. Otherwise, you all know that short term capital gain is covered under the regular slab rates applicable to the assessee. However, 111A short term is not covered under the regular slab rates. It will be covered under special tax rate. And yes, also rightly pointed out by Shri, it is concession rate, and Gulik also pointed out we have to check the date, the landmark date or the important date for capital gain transactions, that is 23rd of July 24. Now, in our case, it is before that date. But just what is the difference? So tell me, what would be the difference between the tax rate under both these sections? If it is 111A, that is short-term capital gain of equity shares, equity oriented funds, STD paid, or long-term capital gain, again long-term same, equity shares, equity oriented fund, STD paid. Shri says yes, very good, Shri. So tell me pre and post, because in the last class we discussed this only. We discussed capital gain only. That is why I'm just pressing more. Very good, Gulika. You're right. Tell me about 112A. So students, if it is short-term capital gain under 111A, then pre, that is before that date of 23rd of July, the tax rate on 111A transactions was 15, and post this date of 23rd July, it has become 20%. Correct, Gulika? What about 112A students? Because if the same transaction of equity shares or units of equity oriented fund, STT paid, if the transaction is of long term, what is the situation? What is the tax treatment? Chalo, you may immediately open your modules, capital gain chapter. Good. Shri, my question is simple. Now, 111A rates I have written pre and post. Now, I want the rates for 112A pre and post. Very good. Siddhas Sanghani, correct, beta. No, Shri, you're not completely correct. Gulika, but in 112A, there is no scope of indexation. So the indexation part which you have mentioned does not apply better to 112A, correct? Very good, Lokesh. Yes. So I'm putting down the answer. The rate under 112A pre-amendment was 10%, post-amendment is 12.5%. Correct? Okay, super. Students, this is how you should do revision. Take a practical sum and while solving, revise everything that relates to that sum. Don't limit yourself to the answer. Many times I've seen students are more keen on getting the answer correct. Sorry, we are doing revision. And revision, the best way is taking up sum. Whatever comes in the sum, maybe it is capital gain, maybe it is set off, maybe it is tax rate. Please revise everything, because in this type of a setup, that is a sum which covers everything. This is the best way to prepare yourself for exams, because till now you prepared, but you prepared chapter wise. Now this is how you prepare for exams. So coming back to the point, so with this, we revised something from capital gains also, which was covered in the previous class. So we again revise it now from this perspective. And now we come to this question where it is said that you have a capital gain of 50,000. Now we all know capital gain is there. So there is no question of setting it off from anything else because we set off losses from other heads. This is gain or income. And the second thing that is given over here is that the date is 10/5/24. So we know it is still in the old rate. So the rate will be 15% because it is covered in 111. Now, at the same time, they have given the second part in this question that there is a long-term capital loss of 75,000 from some other asset, which is sold on 15/10/24. That is after the date of 23rd of. Now, this is a loss. Now, the moment you have a loss, the first thing that should click is whether it can be set off. If not, whether it can be carried forward. If it can be set off, against what? Are there restrictions? In case of HP, there is some restriction as to amount. So all these things should take in so that you can accordingly decide. So now I'm raising this question. So long-term capital loss 75,000. Can you set it off? If yes, against what? And second, if not, then carry forward under which section, up to what time limit? And third, is there any amount limit like you have for HP? Fourth, is there anything in the new scheme, old scheme relating to this? Because now you have to see everything step by step. Like for HP, we just said that if it is old scheme, the treatment is different. And if it is new scheme, the treatment is different. So here also, long-term capital loss, step by step. Set off or carry forward. If set off, against what? If carry forward, for what period, with section? And any special treatment under new scheme, old scheme. Okay, Gulika says carry forward for 8 years against LTCG only. Okay. So Shri says long term can be set off against short term. Okay, Shri, you are saying long term set off against short term. So in this case, I have a short term capital gain. So you meant to say, Shri, I can set off this loss of 75,000 against that. Okay. Gulika is giving me section number perfect. So 74 deals with the carry forward of capital losses, both long term and short term. You are correct. Lokesh says long term capital loss cannot be set off. No, don't say this, Lokesh. You should not say this way because this way the answer is incorrect. You are saying long term capital loss cannot be set off. That is wrong. You should say it can be set off only against, because it is not that it cannot be set off. It is set offable only against. Like winnings loss. Winnings loss is non-set offable. Capital long-term capital is not that way. It is set offable only against. Correct? Yes, you are correct. 8 years carry forward. Section 74. Kushi says long-term capital loss can be set off with long-term gain only. Very good, Kushi. And if not, then carry forward for 8 years for under section 74. Perfect. Gulika, STCG can be set off against STCG and LTCG. You are right, Gulika, but here our loss is long-term. So we are talking about long-term. Carry forward 8 years, long term can be set off against long term. Okay, perfect. Excellent. Gayatri. So students, so the conclusion is that long term can be set off only against long term capital gain. We'll see if there is anything else below. If not, then you'll have to carry forward a date under section 74 for 8 years. And obviously in future also, you will require long term gain to set it off. Fine. Now, most important point. Any different treatment when it comes to old scheme, new scheme? Any different treatment? Also here the date, because it is a capital item. So again, the date, it is falling in the post period. Anything different if it is falling in the post period? See, these are the things which you all have to check when you are answering the question, students. So that is why I'm decoding it in that manner so that you train your mind to read the question in that fashion. So step by step we are going. So two questions I have posed. Any different treatment under old scheme, new scheme, and any different treatment if the date is pre or post. So Siddha is saying it can be set off only with capital gain under 115 BAC. Okay, then what about the other? So 115 BAC is the new scheme, default scheme. So you mean to say something else in case of opting out? Siddha? Okay, Gayatri says, sir, both schemes, same treatment. Okay. Kushi says the same, no difference with respect to regimes. Okay. Okay. Super. Lokesh says same treatment. Gulika says income generated is taxable in the hands of wife. But wait, I have not yet gone to that point. But Gulika, why you are proceeding? We are still on this point. Lokesh says no change in treatment. Siddha says can be set off only against any head. Siddha, sorry, you are taking it wrong. Somewhere we are talking about long-term capital loss. Your previous answer and this answer both are not matching with the provision of the law. So please check. Yes, students. So the answer given by few, which is correct, is long-term set off against long-term only. If no long-term, carry forward under 74 for 8 years for being set off in future also against long-term. And there is no different tax treatment, whether it is regime. And also there is no different tax treatment because of the date. Why? Because of the date, what changes is the indexation with without indexation tax rate. But since already they have given the computed amount, which is a loss, for loss, there is no different tax treatment, whether it is pre or post. So in the given case, we will have to check if there is any further long-term gain. If not, we will carry forward it. Fine. Now, Mr. K divorced from his wife in April. Now, again, this is significant because this is the year of divorce. And what is significant is when we come to clubbing. In clubbing, there is something relating to clubbing of spouse. And in that, divorce has a special exception. So let's see. Again, if not clear, we will go to the section. If you're not able to recall the nitty-gritties, no problem. We'll revise from the section. It is fine. But I just want to make it a point that whenever it is about spouse, there is clubbing. Whenever it is about minor child, there is a clubbing. Whenever it is about spouse and something is relating to agreement to stay apart. So the law does not uses the word divorce. The law uses the word in connection with agreement to stay apart. Then the clubbing provision has some exception. What is it all? If you all are able to recall, fine, or else we will read from the provision. So what it says, he took divorce from the wife, and this is in the current year only, which will be significant, how that we will see. And the custody of the minor son is given to wife. Now, again, this is going to be significant because clubbing of minor child also has a bearing on with whom the minor child stays in case of divorce. So we'll see both these provisions. Next, following the divorce, now this is again important. Following the divorce, that is because of the divorce, he transferred the ownership of his property to his wife. Good. During the financial year, the property generated rental income of 5 lakhs. Okay. Anything for minor child? Okay. But that will come later on. We'll not mix two things. So firstly, it is about clubbing of income of spouse. So what does the provision says? Section 64 says that in case of income which is earned by spouse out of any asset, property, which is given without consideration or for inadequate consideration. So if there is any asset, property, like here it is a house, which is given. So it is a house that is a asset or a property which is given without consideration, then the general rule is whatever income is generated from such asset or property, that income shall be clubbed. So in this case, if husband has given this asset to spouse, then whatever income is generated, it will be taxed in the hands of the husband. However, this entire rule has an exception. What is the exception? If this giving over of property or asset without consideration to spouse is on account of divorce. In our language, in the language of law, on account of agreement to stay apart, then the clubbing will not apply. The income will remain taxable in the hands of spouse only, and it will not be clubbed with husband in this case. So Shri says exception is live apart. Very good. Kushi says for transfer of asset without consideration, it is deemed income of K. However, clubbing will not be attracted. Very good. Next, Nagaraja says, sir, minor son custody. That will come. See, that affects the income relating to minor child, Nagaraja. So right now, I'm limiting my explanation only to clubbing of spouse, just to avoid any confusion. We'll come to that point when we go to the point of clubbing of minor child. So everybody agrees that this income of 5 lakhs, which otherwise is covered in clubbing, because it is arising out of asset which is given without consideration to spouse. However, here the clubbing will not attract because of the specific exception. That is, if it is given in connection with an agreement to live apart, which in our day-to-day language we call it as divorce, sorry, then clubbing does not trigger. So as rightly pointed out by you all, in this case, this income of 5 lakhs will not be clubbed. Correct? So for the time being, no tax treatment of this. Otherwise, this would have gone to HP head. Correct, na? And over there. Acha, chalo. Just out of curiosity and out of revision interest, let us say this divorce part would not have been given. What would be the tax treatment of this 5 lakhs? If this divorce would not have been given. In the normal scenario, he has given the asset to his spouse. What would be the tax treatment of this 5 lakhs? Lokesh is saying it is clubbed in the hands of husband. Good. Nagaraja is saying in that case, income charged to Mrs. K. Why Mrs. K? Mrs. K is the wife, na, who is getting the house. Kushi says Mr. K would be deemed owner and income from HP would be clubbed. Okay, good. So tell me the amount. Nagaraja says what? Divorced. What is divorced? So beta, that is done, na? Divorce is there that we discussed. Now I have modified the question. I'm saying, had this point of divorce not be given, what you would have done of this 5 lakhs? This is what I'm asking. We have already concluded that it is not going to be clubbed here because that asset is given on account of agreement to live apart. But now I have modified this. Very good. Kavya is saying, sir, 3,50,000 is taxed at the hands of Mr. K. Gulika says again, same 3,50,000. Kushi says 3,50,000. This is what I wanted to hear from you all. Because many times the mistake that we make is that when we say clubbing, we directly club the amount entirely. So the rule is when clubbing applies. So that is why I'm coming to this point. I have modified the question just for revising the provision. Had clubbing applied, you would have clubbed the income under the respective head. So where it would have gone? It would have gone to the respective head of Mr. K, that is HP, point number one. Second, when it goes to HP, entire 5 lakhs will not be taxed. You will do computation as per the HP format. So 5 lakhs will become GAV, municipal tax not given, so nil. Standard deduction 30% of 5 lakhs will apply. So it will be rupees 150, which will be deducted. So your final HP income would be 3,50,000. Very rightly pointed out by Nagaraja, Kushi, Gulika, and Kavya. So you all are correct. Had this exception to clubbing not be there of divorce, and clubbing would have attracted, so this would have gone to the HP head, and the taxable amount from this property would have been 3.5 lakhs. Very good. Now we come to the next point. Mr. K has deposited money of 50,000 every month, okay, into the bank account of his minor child. During the current year, the interest income which has been generated is 25,000. Now, again, once it is a minor child, clubbing under section 64 bracket 1A is attracted. What does the clubbing says? Income earned by minor child. Now here, the deposit is given by Mr. K. Other way also would have been possible. Deposit was given by Mrs. K. So who is depositing the money? Is it important that if Mr. A is depositing or if Mrs. K is depositing, the answer would be different. So my first question in this clubbing is, I'm now talking about minor child clubbing. They say Mr. K has deposited the money or is depositing the money and interest is being earned. My question is, had Mrs. K being depositing the money, what would be the difference in the clubbing provisions of minor child income? Chalo, recall. We need to revise entire minor child clubbing. Okay. Club with Mrs. K, as she has the custody. Okay, that is fine. But my question is, so we have answered that also, Gulika. Fine. Kushi says in general cases, income of minor child is club with income of parent with higher income. However, here due to agreement to live apart, the income will be club with Mrs. K. Okay. So 25,000 less 1,500, 23,500 to be club with parent whose total income is higher. Okay. So the particular question that I was asking is whether the clubbing is affected by who is depositing the money in minor's account. The answer is no. Whether Mr. K is depositing or in the sum it would have been given that Mrs. K is depositing makes no difference. Income is clubbed with that parent whose TI is higher. So between both the parent whose individual total income is higher, you will club this income with that particular income. Correct? Now, first point. Second point, very important, is that this rule has an exception that it would be clubbed with the parent whose income is higher. The exception is that if there is a divorce, that is, they are staying apart, in that case, it will be clubbed with the person with who has the custody. So as rightly pointed out by Kushi and if I'm not wrong, even Gulika, that in case of divorce, it will be clubbed with the person who is having the custody. Now, in our example, Mrs. K is given the custody. So it is clubbed with Mrs. K. And we are doing computation of Mr. K. Hence, No tax effect in the hands of Mr. K. Right? So 2 points. First rule, it is club with the parent whose individual total income is exception. If the parents are staying apart, it is club with the person with whom or the parent who has the custody. Now just let me complete this. There is an exception to clubbing where clubbing will not happen. Now, firstly, where clubbing will not happen does not mean the income will be not taxable. When we say clubbing is not applicable, it means the income will be taxed in the hands of the minor child himself or herself. So now, exception where clubbing does not apply, that is income taxable to minor child, not to parents. It does not mean where I say clubbing is not applicable means the income is exempt or it is not taxable. No, it is taxable, but in the hands of the minor child only. What are the cases? Where the minor child is physically or mentally challenged. In common language, you call them as handicap. First, or the income arises because of skill, talent, or manual labor. That is, if the child himself was earning the income by acting in some serial, movie, or by doing some singing, dancing, or is actually working somewhere. So out of the manual labor or work, the child has earned the income. So in these two cases, the income is taxed to the child itself, not clubbed with any of the parent. Correct? Interesting point. Now here, just pay attention. In this case, because this is not there in this question, but I'm just revising the whole point. So let us say it is given that minor child earned rupees 5 lakhs from acting in some serial. This 5 lakhs won't be clubbed. After earning this 5 lakhs were made FD, on which the interest earned is 25,000. So the minor child earned 5 lakhs through this skill, talent, etc. This 5 lakhs not clubbed as per this exception. Further given, this 5 lakhs were deposited in FD, and on that FD, the interest earned is 25,000. Whether this 25,000 would be clubbed or not. Very good, Gayatri. So the answer is, even though this interest is earned from that amount, which was originally earned through skill talent, but since this interest is not earned through skill talent, clubbing applies. So 5 lakhs not to be clubbed, it would be taxed in the hands of the child itself. But this 25,000 will again be clubbed as per this rule. Only case where no income is clubbed and all incomes are taxed to the minor child itself is where the minor child is physically, mentally challenged. Then all incomes of the minor child, however earned, will not be clubbed, would be taxed to the minor child itself. Very good, Kushi. Very good, Vaishnavi. Correct. So Gayatri, Kushi, Vaishnavi, your answers are perfectly right in this relation. Now, let us say, again I modify this question. Same modification, had there been no divorce. Because now there is a divorce, the child is maintained with Mrs. K. So we have concluded that the clubbing of this 25,000 is in the hands of Mrs. K. But I change the example. Let us say there is no divorce, or other way around, even if there is a divorce, the child is with Mr. K. So this is the bottom line. The child is with Mr. K. What would happen? What would be the answer? Had there been no divorce, and let us say Mrs. K is not earning any income. Or second, there is divorce, but Mr. K is having the custody of the child. Now give me the answer. What would be the tax treatment? So one answer which is already concluded for this sum is 25,000 is not taxable to K, whose working we are doing. It will be clubbed with Mrs. K. But now I'm again modifying it just for our understanding purpose. That Mr. K is having the custody. Gulika, will this be always? Correct, Khushi. So I'm changing. My answer is, my change is that there is either no divorce or whatever it is, the child is maintained. Let us say there is a divorce and child is with K. Nagaraja, will it be 80U? So first is, it will be clubbed under with Mr. K, correct? Second is that 1500, there is an exemption whenever clubbing happens. But again, you have to check that exemption applicability with respect to what scheme. Here, the person is opted out. It means it is in the old scheme. So 1500 exemption available. Had this person not opted out, in that case, entire 25,000 would have been taxed. Am I correct? Perfect. So the final and complete answer is, in this case, 25,000 is not income of Mr. K. Done. Just for revision, had it been income of Mr. K, because let us say the child is maintained by Mr. K, then this 25,000 would have been clubbed under the head other sources for Mr. K with an exemption of 1500 because Mr. K has opted out. Had he not opted out and had he continued with the new scheme, that is a default scheme, then entire 25,000 would have been taxed. Correct? Okay. Now the next part. He has contributed a sum of rupees 2 lakhs to electoral trust. Okay. So now we switch to investments, and there is a contribution, a donation to electoral trust. And further it is saying a sum of rupees 2 lakhs and incurred expenditure of 30,000 on putting an advertisement in the brochure of a political party. What is the tax treatment? Nagaraja says 80G deduction. Okay. Anything else? It is not 80G because in 80G you do not cover political parties or electoral trust. See, there are two sections, GGB, GGC. It is easy to remember because these are the two main political parties of India. So whenever you are giving donations to political parties or to electoral trust, correct? The deduction is allowed under 80GGB if you are a company. If you are not a company, it is allowed under GGC. And how to remember these section numbers? I have given you the small trick. Now here the person is not a company. The person is individual. So technically the section applicable to us is 80GGC. But again, Before you decide for taking or not taking the deduction, you have to check for the scheme. Since it is given that he is opting out, hence now the deduction will be available. Had he not opted out, continued with the original scheme of default, that is the new scheme, then the deduction would not have been allowed. So this deduction is available, correct, because he has opted out, so he's in the old scheme. This amount is not available as deduction because the section does not allow deduction by way of advertisement in the pamphlet, brochure, tract of a political party. Further, one more important thing over here is this amount should not have been paid in cash. Otherwise, this will also not be eligible. So you have to write a suitable assumption. You can take either of the assumptions because nothing is given. Better assumption is you say that we are assuming it is not paid in cash. And then in that case, you will be taking this 2 lakhs deduction. There is no upper limit of this deduction. So whatever is the amount to the extent of all the regular tax rate incomes, you can avail the deduction. You cannot avail the deduction against special tax rate incomes like short term under 111A, long term 112 or 112A, winnings. Against these, deductions are not allowed, but against all regular incomes, deductions are allowed. So 2 lakhs allowed as deduction under 80GGC. Then it is given he has authored what investment portfolio book. So okay, basically he's author of a book and he is receiving royalty. Okay, first, which head income? Now for royalty on books, there are two possibilities. If let us say a person like me who is a professional, I am writing a book related to my profession, like the subject of taxation, if I'm writing a book, or I'm writing a book on litigation, both these are my profession subjects. And being part of books publication and all is my regular routine being in the profession. This would come under PGBP. But if there is no such thing given in the question, then you will consider this under the head other sources. Now here there is no such thing mentioned, whether he is a regular author and writing books is also part of his profession, etc. Then it is always better and safe to treat it as other sources income. Now, so we have to do computation under the head other sources. Now, what will be the taxable amount under the head other sources? First point. So he has authored a book and he has received 410 towards royalty income during this year from a publisher in Germany. The royalty is calculated at the rate of 16% of the sales value of books. He spent 60,000 as expenditure for earning this income. And out of the total royalty of 290, which was remitted to India by this date, the balance is still not remitted to India. Now, what is the relevance of this 16% and this part? That is because there is a deduction under 80QQB. So for the purpose of computing this deduction, this data is relevant. But firstly, for the purpose of other sources, the simple calculation is 410 is your royalty. Expenditure is 60,000. So your income under the head other sources has to be 350. First thing. See, this is how you will be solving the questions. You will be first doing some oral or simple workings before you can make the final computation, because there are so many things you should not mess up in the final computation. So you should first do this, and especially when there are so many ifs and buts, you have to be very clear. This, whatever I've done on this page, you should do on the rough paper, which you can use last 1 or 2 pages of your answer sheet. You should not write anything on the question paper. That is not at all allowed. Whether in pen, pencil, nothing is allowed. You should only write your seat number on the question paper. Nothing else is allowed. So all these things, you will write it at the back of your answer sheet. So you can call it as working note or extra working paper and give the question number and start writing this, whatever I'm writing here, or whatever you want to recall when you're doing the final answer. So this is one part, that income under the head other sources will be 350. And then the other part would be the deduction under 80 QQB. But before we go to the working of the deduction, again, you will check the eligibility. Again, since he has opted out, that is why he is eligible for this deduction. Now, what is the working for the deduction? The working for the deduction is there is an upper limit as to the percentage at which you can earn royalty. The upper limit is 15%. Now he is getting 16%. So even if you want to compute the deduction under 80 QQB, firstly you have to find out what is the eligible amount. The eligible amount is lower of two figures. The first is the amount at 15%. Now what will be the amount at 15%? So 410 is at 16. So divided by 16. So how much will be at 15? You get an amount. Compare it with the amount which is received in India in convertible foreign exchange. So only what is received in India in convertible foreign exchange is eligible. So one is amount at 15%. Second is amount in convertible foreign exchange. It is 290. Yes, correct. So Kushi, Golika have given me the figures of 15%. It is 384,375. 384,375. So whichever is lower, 290. So 290. But since you have spent some amount, that would be deducted. So how much it is coming to 90 minus 6230. So since this is old scheme, you can claim this deduction of 230. So this is how entire working will happen. See students, I repeat, my interest is not in giving you answers. That is anyways here. Once this is uploaded, you will get this. And anyways, this is also part of our MTP, RTP question banks. We have taken it, we have compiled it just at one place so that we can do chapter-wise revision. What I want to tell you all, which I want you all to also practice in this fashion only, don't only aim at solving the answer full. Aim at revising the chapters. So your first round of revision should be like this only, because right now you are not thorough with the provisions, everything. You are not able to recall certain things. You may not have completed the study or revision. This approach will help you a lot. So your first round of revision, somebody asked me in the previous class also, I repeat, first round of revision should be like this. Take a question, go to the provision, don't go to the answer. Now you will be having answer in all MTP RTPs, but my humble request will be, again, if you go and check the answer, your revision will stop. You have to go to the provision, read the provision in the light of the question, derive something, write something there, maybe in rough, like how I am writing, because right now we are in our first revision round. So just write something somewhere, may not be do the full presentation immediately. First, revise the provisions, because in the initial part, when you have just completed studies, the first big challenge is recalling, and also recalling in a comprehensive format. So for this, I repeat, please follow this approach. Don't go to the answers. Answer presentation is second. Final answer is third. First is provisions. Applying them, firstly recalling them. So do this way only. Correct? We can go through the answer and presentation. I'll just skip this, students, just for saving time. You can always go through this. My purpose is giving you the feel of and the revision of the topic. Okay. Now we again go to the next question. This, I suppose, yes, is a case study question. Now, what is our rule? Whenever you have a case study question, you should first read the question and then go to reading the case, so that your reading is precise and you do not waste time. Now, actually, this question has multiple other questions, but since we are limiting our revision to particular chapters, only that part of this whole case study is taken, which is relevant to this chapter. Now, what is the question? What is the amount deductible under chapter 6A? So from the facts, you have to derive the deduction. Okay. Mr. Raj, aged 38, so not a senior citizen, manufacturing business, Canada, frequently visits India. Okay, this is the residential part. We are not interested. Okay. He does not own any house property in Mumbai, still staying in rented accommodation. Now, students, is there any deduction for staying in rented accommodation? Students, is there a deduction? Okay, Lavanya says yes. So, Lavanya, what is that? Acha, firstly, what is this scheme, old or new? That is also relevant na, for deductions. Opt out. Okay. Only then deduction will be there. Otherwise, it may be nil. Okay. Very good. Kushi has given me even the section number correctly. It is 80GG. So under 80GG, you are allowed deduction for rent paid in case you are staying in rented accommodation. And how much it is very similar to what you study in salary chapter. If you recall salary chapter, over there we have an exemption under 10 bracket 13 capital A for HRA, which is the least of three. Correct? This is I'm talking about salary HRA exemption. Similar to that is the condition over here. So if you are staying in a rented house, first you should not be a salaried person, because if you're a salaried person, then maybe you are claiming exemption under 13E. So I won't give you any benefit here. So first you should not be a salaried person. Second, you're not claiming any benefit under HRA. Then you are eligible for this deduction. Now this deduction is least of three amounts. And these three amounts are very similar to your HRA working. One is 25% of adjusted GTI. Second is 5,000 per month. And third is rent paid minus 10% of adjusted GTI. Now, if you recall, under salary chapter, for HRA, the exemption is 40 or 50% of salary, correct? Instead of that, we have here 25% of adjusted TI. Very good, Gulika. Yes, Lavanya, correct. So I'm just making parallel, drawing parallel so that the both things are revised. So for HRA under the head salary, the least of three figure is 40 or 50% of salary. Here it is 25% of adjusted UTI. Second figure over there is actual HRA received for the relevant period. Here instead of actual HRA, it is a flat figure which is 5,000 per month. Third figure over there is rent paid minus 10% of salary. Similar to that over here is rent paid minus 10% of adjusted GTI. Yes, Vaishnavi, good. Now, least of this is eligible for deduction. So, monthly rent is 20,000. Okay. So, you will have to find out this. This is anyways into 12 months, 60,000. And rent paid is 20,000 into 12 months minus 10% of adjusted GTI. Okay, fine. Let's see. Now, next is he made a donation of 50,000 to PM Care Fund. What is the deduction? Firstly, under which section and what percentage? Which section? What percentage? Very good. Is it 100? Because somebody has said also 50. So is it 50 or 100? PM Care Fund. Yes, very good. So Gayatri, Khushi, Vaishnavi, well are correct. It is 100%. So entire amount which is deposited is eligible for this deduction. Further, 20,000 donation is given to Prime Minister's Drought Relief Fund. What is the uh, amount for this? Percentage for this, sorry. Yes, here it is 50%. Yes, very good. Kushi, Vaishnavi, Siddha, Lokesh, very good. So 100% of this is 50,000 and 50% of this is 10,000. So under 80G, your eligible deduction is 60,000. And then this calculation, which is pertaining to capital gain, which we did in the previous class, because this question was also there, only we did not do deduction there. So that is what is there. And also there is this income, PGBP income, 15 lakhs outside India and 5 lakhs from India. So considering all this, you will be able to determine your GTI. From GTI, you exclude income which are taxable under special rates. So this long-term capital gain would be excluded because long-term capital gain has a special rate. Short-term capital gain under 111 is also excluded because it is also having a special rate. So in that particular case, those things are excluded. Only the income at regular rates, which will include PGBP, which will include this interest on these debentures, that is what would be considered. And then you will complete this working to determine the deduction. Fine. Now, next question. Okay, this is computation. Which approach he has opted out? Very good. Sure. If you want, take a screenshot of this. Take a screenshot. Now take a screenshot of this. Done. So should we start? Okay. Lokesh, but I now don't recall which year question paper because that noting is not maintained here. No problem, na, but what difference it will make? Anyways, if it is of past question paper, you will have to first modify the question to match to current provisions, right? Now, salary, wow, this is the biggest relief for me. Salary is given computed because that takes a lot of time in the question. Rent is received, so we have to do HP working. It is situated in Delhi. We'll see if no other details like municipal tax and all are given, then simply minus 30%, it will be our HP income. Repayment of loan for the purchase of above. Okay, so interest is there. Loan was taken from a friend. This repayment includes Acha. So in this, there are two parts, principal and interest. So interest is 7 lakhs and principal is 8.25 lakhs. Right. Now, my question to you all is, otherwise, we all know what is the treatment. Interest is allowed as deduction under HP head and the principal will go to your deduction under chapter 6A ATC. But there is a question or a issue. The loan is taken from a friend. Does this point disentitle you from getting the deduction of interest or from getting the deduction of principal, or it is okay even if the loan is from a friend, you will be getting both the deductions? I repeat my question. This information that loan is taken from a friend, whether this is okay for getting both the deductions, or will this information disentitle you from getting the deduction either for this HP head interest or for chapter 6 ATC deduction of principal? Lavanya says no deduction allowed. Okay. Why, Lokesh? Good inputs. So Lokesh says only interest is allowed as deduction. Lavanya says no deduction. Kushi says under 80C 825, acha, the principal portion is allowed only from bank, government, or specified employer. So here you mean to say from friend it is not available. Gayatri also says similar thing. Siddha says it is allowed. And Lavanya says deduction allowed for interest, but up to 2 lakhs. Oh, wow. So I have so many answers, so many laws. See, the correct version is, firstly, you have to check whether deduction under Chapter 6A applies. Answer is yes in this case. Why it applies? Because you have opted for old scheme, that is, you have opted out of the default scheme. So interest applies. Now, in this particular case, since interest applies, hence the most important, Chapter 6A deduction applies. Now we have to check whether the principal is eligible for Chapter 6A deduction under 80C. So as rightly pointed out by Kushi, Gayatri, and Lavanya, but Lavanya has given more generic answer that this deduction under 80C will not be eligible. Why? Because the loan is taken from friend, and the requirement of 80C is it should have been taken from financial institutions like bank, NBFCs, or government or specified employers. Since it is not, it is taken from friend, 80C is not available. Now coming to the next part, that whether you are eligible for uh, interest deduction under HP head. So the answer is again given correctly by Lokesh, maybe even by Gulika when I asked that question, that yes, it is allowed. Siddha has also given answer, but a generic answer, so I'm not able to understand which it relates to what. So 7 lakhs, which is the interest component, is eligible for deduction under the head HP. And let me correct you, it is eligible fully without the limit of 2 lakhs. Why? Because the 2 lakhs limit, Lavanya, I had mentioned this, I think today or last time, today only, is applicable only if the property is self-occupied. For let out properties, but there is no limit on interest deduction. So when you are computing this PGBP income, you will be eligible to take the deduction for entire interest because the property is let out. Correct, beta? Okay. Then he has another property in Jaipur for which the rent received is this. Again, since it is let out, it will also be taxed as let out after allowing standard deduction and all. We'll have to just see if municipal tax is given. Further, interest on loan taken for repairs. House property in Mumbai and Delhi. Okay. Delhi is this. Where is Mumbai? Acha, Mumbai they have given below. Interest on loan taken for repairs of house property situated in Mumbai and Delhi. The property in Mumbai is self-occupied. Oh, now this is not uh, done from my side. Why? Because, acha, sorry, they have given the ratio. Loan was taken on this date and it was utilized 50-50. Okay, sorry. So they have given the breakup that out of this interest, Mumbai share is 75,000 and Delhi share is 75,000. Now, first coming to Delhi. For Delhi, you already have a loan which is for purchase of house where we just concluded this portion is not eligible for 80C, but 7 lakhs is eligible. So this 7 lakhs is eligible. Now, first talking about Delhi, is this 75,000, which is another loan for Delhi house taken for repairs. whether this 75K is eligible as deduction for Delhi house. And in while computing the income, HP income of Delhi house, will this be eligible? Gayatri says renovation loan upper limit is 30,000. Okay, so Gayatri says it is allowed up to 30. Pushi says yes, it is allowed. Lavanya says 75,000 is allowed. Okay. Gayatri, entire 75,000 is allowed. So I'm just adding it here. Why? Same reason, beta. This is a let out property. For let out property, 2,30,000, no limit applies. Whether the loan is purchase or repair, renovation, entire interest for let out property beta is eligible. You don't apply any limit, right? Now for the Mumbai house, which is self-occupied. Firstly, for Mumbai house, GAV will be nil. Everything will be nil. Only interest is eligible. Now for Mumbai house, what will be the amount of interest eligible for deduction? Because Mumbai house is a self-occupied house. Very good. So now, Gayatri, here the answer will be 30,000 as rightly pointed out by Khushi, Lavanya, Gulika, that here, while computing Mumbai house, only 30,000 towards interest is eligible, not 75K. So interest up to 30K is eligible because here the limit of 30K applies because the property is self-occupied and the loan is taken for repairs. So all the above data will help me compute the PGBP income. So I have three, sorry, not PGP, sorry, HP income. So I have three, one in Delhi, which is let out, one in Jaipur, which is let out, and one in Mumbai, which is self-occupied. Okay. Long-term capital gain on sale of equity shares, STD paid. We discussed this in the previous, that this is long-term under 112A. Any date given? Date is not given. Why? Because actually this could be old exam sum. So I modify and I write the date as 25th July 2025. So firstly, this is income. Can you give me the tax treatment of this? I've added this date just for our reference. So can you give me the tax treatment of this? Very good, Khushi. Very good, Gulika. So this is taxed under 112A. Now, when you will be computing tax, not now. Now here we are only computing income. In income, entire 725, 95 will be there. But when you are computing the tax, at that time you are allowed to deduct 125 from the amount of income, and the balance, if any, left would be taxed at 12.5%. So this 125 would be deductible, but not now while computing the tax. So when you are in tax computation, which is not asked in this sum, but we are revising the entire thing. Yes, Gayatri, you are right. So when you are doing tax computation, you will be deducting 125 from the amount of this income. This is other sources loss. This is PGBP, speculation business profit. Now my question, now both are PGBP, but this is a loss and this is an income. Now you have speculation income and regular business loss. So can this 750 be set off against 230? And if yes, definitely something will be left because you have higher loss, can it be set off against other head incomes? So Lavanya, you answer both questions first. Can it be set off against this speculative income? And if required, because definitely the loss will be left, can it be set off against other head incomes? Very good, Kushi. Very good, Lavanya. So this loss, first you can set it off against speculation because restriction is on speculation loss, not on speculation income. So if you have any other loss, that can be very well set off from speculation income. So we'll first set off this because the rule is you should first set off under the same head. There is one more item under the head PGBP, that is loss incurred by a firm in which he is a partner. So if this 160 is your share in the loss, correct? The point is the profit or loss of the firm is taxable in the hands of the firm. So in your hands, this loss, whatever could be your share, is exempt. Otherwise, this would also have come in your PGBP head. Now you have received salary as a partner from your partnership firm. So this will be part of PGBP. So this will also be taken under this head only. So under PGBP, you have loss 750, profit 230, and another income from partnership firm 50. All these will be taken under the head PGBP. And then this loss would be set off. And whatever is the balance loss after setting off this can be set off against other incomes except salary, except winnings. Here, fortunately, we have winnings. So it cannot also be set off against this. In fact, no loss can be set off against winnings. Winnings are always taxable gross. So winnings would be taxed gross. So even this 750 loss, or if there is loss under any other head, nothing can be set off against winnings. And this loss under the head PGBP can be set off against any other head income except winnings, except salary. And then last point is life insurance premium paid for his son who is 30 years of age working in US. Is this eligible as deduction? Now why 30 years? So the son is major. Working means son is not dependent on you. So the son is independent, son is major. Whether you are eligible for deduction of premium where your child is major and also not dependent on you. Very good, Lavanya. So when it comes to LIC premium, there is no such restriction. So yes, under ATC, correct, Gayatri. So Lavanya, Gayatri, both are correct. It is eligible as deduction, but yes, had this been medical insurance premium, then in case of medical insurance premium, this would not have been allowed as deduction because over there, the children should be dependent on you. Major minor is not a matter over there also, but over there, the criteria is the child should be dependent on you. Now, in this case, had this been medical insurance premium, deduction would not have been allowed. Also, keep in mind you are opting out. That is why only the deduction is allowed. If you would not have opted out, then anyways, none of these deductions would have been allowed. But right now, this will be allowed in ATC. So ATC will have only one deduction. Above deduction, we already rejected because you had taken loan from friend. So that deduction of principal portion is anyways not eligible. So only one deduction is available. Further, you have some brought forward losses of the past year, brought forward short-term loss. So this can very well get set off against your short-term income. So you have some short-term income here, short-term gain under 112A. Where is it? Yeah. No, sorry, you have long-term gain under 112A. So against that, short-term loss can very well be set off. Vice versa is not allowed, which we saw in previous sum, that long-term loss cannot be set off against short-term gain. But here you have long-term gain and short-term loss, so that can very well be set off. So this you will set it off against your long-term gain under 112A. Plus you have brought forward loss on equity, sale of equity shares under 112A. So again, it is a short-term loss. So both these losses are very well adjustable against this long-term gain. So from this long-term gain, you are allowed to set off both these losses. So this is the revision of this particular sum. Now here we'll take a break of 15 minutes and then we will come back for this question. So we join at 7:45 again. Yes. So let us go to this question. Is this question dealing with ठीक I think. Let us go to solving question. This is a question of solving. Chalo. So let us start. Mr. Aryan, resident individual working in Nischay, earns a salary of 90,000 per month. Okay. So into 12 months, you will get the total salary income minus the standard deduction and all will give you your income from salary. Okay. So this is point one. Now when we proceed, what else is there? One second. He holds 20,000 equity shares of Alpha, listed company, purchased on this date for 200. These were acquired through recognized stock exchange. STT was paid. Wow. Is there any special date connection with STT paid shares, students? Students, is there any special date related to STT paid? That is okay, Ram. 23rd July is okay. Now I'm talking about on the purchase side. Sales side, yes, for all assets, whether STT paid, not paid. Dhruti, be specific because your question, your answer, though I can say is correct, but it is incomplete. So very good, Gulika. So it is 1st Feb, Gulika. Is it correct? Typo error, something happened? Check the typo, beta. Yes. Very good. So it is 1st of Feb 2018 or 31st of Jan 2018. Very good. Correct. Gayatri, Lokesh, Gulika. Now, what is important? Yes, Gayatri, correct. So now the important point is that if the shares are purchased before this date, so we had something important. That is, we have to check for the FMV on 31st of Jan 2018, correct? And then the amount that was supposed to be taken was comparing three figures, correct? Higher, lower, if you recall, right? Sure, that we will check when we'll go to the computation. In August 24, Mr. Aryan transferred a plot. So this is August 24, so it is after that date of 23rd of July. So he transferred the plot for 70 lakhs, which was acquired by him in May 16. So it is a long-term asset for 22, paid brokerage of 1%. November 24, the company decided to buy back 50% of its shares for 250. So they bought back from Mr. Aryan also. In May 25, Aryan acquired residential property in Kanpur. I think we have solved this sum in the previous class. Students, because I discussed in detail about buyback also, about this 31st Jan also. Just help me. Maybe some with some different adjustments, but I recall very well there was buyback, there was 50% buyback. Okay, but there are other things also, I think. Okay, lot many things. We can do this sum. Anyways, it will be a revision of that buyback also, in case if you all have forgotten. So this part is common, but other parts are different. Okay. What is this question? Aryan, we drop, we go to Suraj. Yes, we go to Suraj, students. Correct? Yes, Lokesh, right. Now, Mr. Suraj, aged 40 years, correct? Submits the following information for the financial year 31st March 2025, right? Fine. He's employed in ABC, earned a salary income of 1050, which is computed. So that much is done. He engaged in speculation, non-speculation business. He earned profit from speculation 60, suffered loss in non-speculation 40. So non-speculation loss can be set off against speculation income. Now I hope you all are clear with this. Nobody has any questions or doubts about this. So this 40,000 loss can be very well set off against 60,000 income, right? Reported short-term capital gain of 80 and received lottery of 20,000 gross. So both will be taken as it is. He has brought forward long-term capital loss of 30 from AY 23-24. So we are in AY 25-26. So it is within time limit or beyond time limit. Is this AY 23-24 loss, long-term loss, still within time limit for the current year? Yes, students, is it within timeline or beyond timeline? It is. But the challenge is it is a long-term loss and we only have a short-term gain. So if you do not get any long-term gain further in the question, it is not adjustable. Fine. Mr. Suraj has two children, one married daughter and a son. The interest income of Ria Raj. What is to be done of this? He has two children, married daughter. Now today, in today's scenario, this is not possible because of various laws, but fine. Only for the purpose of academic, we are discussing this. So, what is the tax treatment, students? Students, help me. This is obviously dealing with clubbing. Also, there is no issue with uh, divorce and all. So it is very clear that it will be clubbed with Mr. Suraj only. Until unless there is something given, yes, it is given computed total income of Mr. Suraj, assuming that Mr. Suraj total income is higher than Mrs. Suraj, so that is done. So anyways, it will be clubbed and he exercises the option of shifting out. So okay, it is even the old scheme. Fine. So clubbing is with Mr. Suraj, correct? But what about? Okay, Kushi has given an answer. Very good, Kushi. That is what is the main point, Siddha. So the main issue is where people are waiting for is what about Ria? Because she is married. So the question is whether her income can be clubbed. That is a question, I think, which is in everybody's minds. So whether her income can be clubbed. Uh, Gayatri says, sir, it cannot be clubbed. With the, you are saying clubbing is there. Kushi also says clubbing is there. Kulika, so that is what is the challenge. Ria is married daughter. So once a daughter is married, even though minor, the question is, can clubbing still apply? Okay, Lokesh says club applicable. Yes. Any other inputs on this relating to clubbing of minor married daughter's income? You know what is the issue? The issue is there is something related to minor married daughter, but it is in HP. It is not for other income clubbing. But again, whenever you are in doubt, the best thing to do is you should read the provision. In fact, that is the best approach so that you will revise everything once again. And even if there is any small confusion, that will get settled. Spouse, spouse, son's wife. Yes. Now see, all income of minor is to be clubbed with the parent. However, the income derived by minor from manual work or activity involving skill, talent, specialized knowledge, experience not clubbed, but it will be taxed in the hands of the minor. So only clubbing is not applicable, but minor will be taxed. Once clubbing of minor income is done with one parent, it will be continue to club with that parent only in subsequent years. So you decide that higher, that whose parents' total income is higher only once, not every year. So if in the first year, whenever the income arises, you determine if it is club with mother, then till majority it will be club with mother, except in case of divorce. That we'll check separately. Otherwise, it will be continuing with mother. Same if let us say when the second minor child starts earning income and at that time it is club with father, then that child's income will continue to be club with father. The assessing officer may however club minor's income with that of the other parent. That is fine. Where the marriage of parents does not subsist, the income will be clubbed with the one who maintains. Fine. However, income of minor suffering from disability specified in ATU shall not be clubbed. Fine. It may be noted that coupling provisions are attracted even if income of minor married daughter. So there is no challenge in clubbing income of minor married daughter, but yes, the issue why you are having is because of something that you have read in HP. I don't know whether it is here. Yes, it is here. So what is given? In case the asset transferred to a minor child not being a minor married daughter, so other than married daughter, without consideration or inadequate consideration is a house property. So this challenge is only relating to clubbing with respect to house property income. So if the transferred asset is a house property, then because of the deemed owner concept under 27(1), the transferor parent will be the deemed owner of the property. Therefore, income from house property will be taxed in the hands of the transferor parent. Now see how this point is different from clubbing. So when you're doing clubbing for minor child, you have to keep HP income aside. Because for HP income, above clubbing section 64(1) is not applicable. How? First, above provision says it is clubbed in the hand of that parent whose income is higher. But for house property income, it is clubbed compulsorily with that parent who had given the property without consideration or inadequate consideration. Difference one. Difference two, in case of other incomes above where it is clubbed in 64(1)(a), the status of minor married daughter makes no difference. Even her income will be clubbed with parent only, not with her husband. However, when it is house property, which is transferred to minor married daughter, so if it is transferred to a minor daughter who is now married, that will never be clubbed with the parent. That will be taxed in a hands on. Second difference. Third difference. For all the above incomes, that is other than house property income, whenever you do clubbing under 64(1)(a), you are getting the benefit of exemption under 1032. However, this is not a clubbing under above section. So again, the challenge would be of this exemption. Correct? So that things you have to keep in mind. So for HP, which is given without consideration or inadequate consideration, was what we call as gift in normal sense to a minor child. The clubbing, firstly, the word clubbing is not correct because it is not clubbing, but yes, it is similar to clubbing because it will be added to the income of that parent who had gifted because of 27, that is deemed donor provision, and not 64, which is the clubbing provision. Therefore, the income from house property will be taxed in the hands of the transferor parent, not the parent having higher income, being the deemed donor, and not in the hands of minor child. I'm just giving a comparative view. So for other incomes which are covered in clubbing above, it is taxed in the hands of that parent who is having higher income, and in case there is a divorce, with that parent who maintains the child. Both things are not applicable over here. Here it will always be clubbed in the hands of the transferor parent because it is not clubbed, it is deemed donor. Second, consequently, clubbing provision under 64(1)(a) would not be attracted in respect of such income, due to which the benefit of 1032 also be not allowed. So this is another difference, that since it is not clubbing under 64, it is deemed donor under 27. So the parent in whose income it is added, that is a transferor parent, will also not be getting the benefit of 1500. However, if house property is transferred by a parent to his or her minor married daughter, now this is important. If house property is transferred by a parent to his or her minor married daughter without consideration, adequate consideration, then 27(1) is not applicable because 27(1) is accepting this. Now, interestingly, in such case, the income from such house property will be clubbed as per 64(1)(a). Again, now as per 64(1)(a), in that parent whose income is higher, and again, then 1032 benefit will be available, obviously, if you are opting out. So see the beauty of the provisions. So 27(1) covers house property gifted to minor child other than minor married daughter. So for all other incomes other than house property, 64(1)(a) applies. And for house property, 27(1) applies. But if it is a minor married daughter and house property is gifted to her, house property income gets covered under 64(1)(a), means clubbing will happen, but not 27(1), but 64(1). I hope this is clear to all students. So coming back here, both incomes of Ria and Raj would be clubbed, and I think he has opted out. No? This is what is the point. Shifting out. Okay. Since he has opted out, we are eligible for the exemption of 1500, which is per child. So this will become nil. 1500, this will become 500. Now, please remember, 1500 is not per month, it is per child per annum. Second, here you have more limit available, you cannot use it here. So 1500 has to be adjusted from that child's income. If the child's income is less, this will become nil. Here you have 300 extra, you cannot shift it in the other child and claim the benefit there. So I hope this is clear to all. So minus 1500. So this is nil. Correct? Yes, good. Now comes the house property point also. He transferred a flat to Ria on 1st April 24 on account of natural love and affection. This flat was let out from that date and generated rental income of 5,000 per month. Now this is HP income. And even though she is married, 27(1) is not applicable, but clubbing is applicable. And clubbing happens in the parent who is having higher income. And anyways, it is mentioned Mr. Suraj is having higher income. So this will be clubbed in the hands of Suraj. Now, how will the working happen? 60,000 is the GAV minus 30% standard deduction. So HP income will come to 42,000 minus 1500 under 1032. So income to be clubbed or income to be taxed in the hands of Suraj on account of this particular case will be this amount. Is this understood and clear? Anybody, any questions or doubts with relation to this? Students, please confirm if this is clear. Kushi says out of 1500, 1200 is utilized for interest income. Oh, yes. Kushi, thank you very much. Sorry, students. Sorry, I missed out on one thing. Very good, Kushi. Thank you. So Kushi has said, ki, sir, out of 1500, we have utilized 1200 here for RIA only. And this working is also for clubbing of RIA's income. So thank you, Kushi. I missed out that point completely. So I can utilize only 300 here because 1200 I have utilized against the interest income of Kushi. So 41,700. Yes, Gulik also highlighted the same thing. Good. Very good. Gulika and Kushi. Very good. So this is interesting. Since she is minor, married daughter, 27(1) does not apply. But since 27(1) does not apply, 64(1) applies and clubbing is done. We just read the provision. So be clear with this part. So if house property is transferred by parent to his or her minor married daughter without consideration or adequate consideration, 27(1) not attracted. In such cases, income from house property will be clubbed as per 64. And once it is 64, 1032 also triggers it. So this is the beauty of law. Correct? Sorry. Correct? Next, Suresh paid medical insurance premium of 22,000 during the financial year to ensure his health, spouse, dependent children. So for medical insurance, we discussed in the previous question also, children should be dependent. If they are not dependent, you will not get the deduction. Now, so this point is eligible. What is the limit, students, for this, for Mediclaim? Firstly, since he has opted out, only then he is eligible for this deduction. Had he been in the new scheme or the default regime, it would not have been eligible. It is given that he has opted out. So he is eligible. But my next question is limit. Whether 22 fully eligible or is there a limit? Okay. Lavanya has given me an answer. Dhruti also has given an answer. Very good. Very good. Perfect. So Lavanya, Dhruti, Lokesh, Gayatri, you all have given me the limits. Yes, Gulika, correct. So the limit is 25,000. So this entire 22,000 is eligible as deduction. Correct. Now, second part in this is additionally, he has paid 33,000 to ensure the health of his mother aged 67 years. But the problem is she is not dependent. Now, whether he will get deduction for mother, first question. Second, if she is not dependent. Third, if yes, then what is the limit? So will he get deduction for mother if she is not dependent? Lokesh says no. Lavanya says yes. Gayatri also says yes. Dhruti says no. Siddha says no. Okay. Any reason why no? Acha, she is not dependent. That is the reason. Okay, Lokesh is giving me the reason. No deduction as the mother is not dependent. Okay. Okay, Gulika also says no because not dependent. Is it required that they should be dependent for the purpose of Mediclaim? The answer is no. Mediclaim requires that only child should be dependent. See, life insurance, no condition of dependency over there. You cover spouse and children without condition of dependency for anyone. In Mediclaim, you also cover parents. And there is a condition of dependency, but only for child, not for spouse, not for parents. So in case you have a doubt or confusion, go back to the provision. Best way. Student, take this opportunity to revise the provisions alongside the practical questions. This will help you remember them much better than simply reading the theory and revising. ATD. What is given? So deduction in respect of insurance paid for family, deduction up to 25,000, which is the limit, is allowed in respect of following payments. Health of spouse, so self, spouse. And for children, they have used the word dependent, correct? Now coming for the parents part. Deduction up to 25,000 is allowed to keep in force an insurance on the health of parents. Word dependent not used. Further, quantum of deduction senior as in an increased deduction of 50,000 instead of 25,000 shall be allowed in case any of the persons mentioned above senior citizen, that is individual resident, an age of 60 or more at any time during the previous year. So even for senior citizen, there is no condition of dependency. So the dependency condition is exclusively for one person under ATD, that is children, neither for spouse nor for parents, not even if they are senior. So the correct answer is by Khushi, by Gayatri, by Lavanya. So you three are correct that eligible, even though she is not dependent, but for parents anyways it is not required. And then the point, entire 33 is eligible because you have a limit of 50. Now interesting point, you already have for them 22,000 and for mother you have 33,000, and since she is senior, limit is 50. Now there is a question. Here I said the limit was 25. Here I am saying the limit is 50 because mother is senior. So whether this 25 and 50 are separate, or I have to utilize this 50 for this and this combined, because if that is the case, my answer will be different. Yes, whether this 50 limit is for the above part also, that is himself, spouse, children, plus mother, entire combined 50, or for above three separate 25 and for mother separate 50. Very good Khushi, very good Gayatri, very good Lavanya, very good. Yes, very good, correct. So Khushi, Gayatri, Lavanya, Gulika, only one correction, Gulika, 25,000 here and 50 here because no one is senior. Otherwise, if anybody would have been senior, here also the limit would have been 50. But here, since nobody is senior, it is 25. It means for parents, this is what I want to highlight in this. So under ATD, for parents, you are given a separate limit. So if parents are senior, then 50,000 limit. If they are not senior, then 25,000 limit. So since here no one is senior, for this you have limit of 25. So 22 is allowed. Here, since she is senior, limit is 50. So 33 can be availed, correct? Now there is also one more point. He also incurred 20,000 as medical expense for father who is also senior, who is also not dependent on him, and who is not covered under any insurance. Now, we concluded that in the case of these three, 25 limit is there. So you have paid 22, 22 is available. For mother, she's senior, 50 limit is there. 33 paid to 33 is also eligible. Now coming to father. Now, first point is he has not paid medical insurance premium. He has incurred directly the medical expense. So let us say for some treatment, the father would have been admitted and he has spent directly on the treatment. So not on Mediclaim premium. So now the question is whether medical expenditure is eligible, point number one. Second, for father who is not dependent, that is parent who is not dependent is eligible, point number two. Third, if yes to both, that yes, it is eligible, one for medical expense, two for senior citizen who is not dependent. Then the third question comes, what is the limit? So Gulika, yes, so then okay. Kushi, you are correct, but then here which limit will apply? You have given me two limits. Very good, Gayatri. Okay, Lavanya. So Kushi, you have given me two limits, out of both, which limit is applicable? So first answer that yes, even medical expenditure is included, but the condition is it should be incurred for a senior citizen for whom insurance cover is not there. Now, why this point is there? Because once a person becomes senior, insurance companies may not give them insurance policy. Now, in this particular case, since they are not giving them insurance policy, hence now for them the law says, okay, no problem, we will directly give you deduction for medical expense. So X deduction for medical expense is also allowed, but the condition is the person should be senior who is not covered by insurance policy. So first, eligible. Second, if the person is not dependent on you and the person is your parent, not dependent, whether it is eligible, answer is yes. Third, if answers are yes, what is the limit? The limit is 50, but the limit is combined for both parents together. So here for self, spouse, children, dependent children, the common limit, it is not per person 25, it is common 25. Similarly, for both parents together, that is mother, father together, the limit is 50. Now, since you have utilized 33 here, out of 20,000 spent for father, you will be utilizing 17, as rightly pointed out by Gayatri. So, no, Gulika, it is not 1 lakh. This is what exactly I'm trying to clarify. So it is not 50-50 each. It is 50 total for both parents combined. So see, there are two limits. This is what I'm trying to highlight, students. First category of family is yourself, your spouse, your dependent children. For these three, combined limit is 25, or if senior, then 50. And then for your mom and dad, both together, the limit is 25, and if they are senior, 50. So here, for both together, beta, the limit is 50 and not 50,000 each. And since for mother you have already utilized 33, so the balance limit available is 17. So out of 20 for father, you utilize 17. So effectively, your deduction, in short, if I have to conclude under 80D, is for your family of three, it is 22. And then for your parents, both combined, it is 50. I hope this is understood and clear. Yes, students. Gulika, but I hope it is clear to you that it is 50,000 combined, not each. So it won't be 1 lakh. So which section you are asking, Gulika? Yes, you have a very good point. So which section you are talking about? Very good. Now, Gulika has added a very interesting point to this. He said, what if this medical expenditure is for treatment of some specified diseases? Whether that would have changed the answer? Because for treatment of specified diseases, you have a section called as 80DDB. Now, who all are covered in 80DDB? It would be yourself, your spouse, your children, your parents, your brothers or sisters. The only condition is they should be dependent. So in 80DD, which is for disability treatment, and for 80DDB, it is for treatment of specified disease. In both, the condition is that these people are covered provided they are dependent on. Now, Gulika has raised a very good question. Sir, if this medical expenditure is for specified ailment, let us say, can we get the deduction under 80DD? Because then 80DD will give me extra limit where I can utilize this entire 20,000. So good point, Golika. So the answer is, I'll show you the provision so that, what is happening? What happened deduction of chapter 6? Now see, when you come to 80DDB, what it says, eligible associate is individual HF, that is fine. Dependent is for individual, it could be any of them, spouse, children, parents, brothers, sisters. So here you will not be eligible because of this point. But again, for the purpose of this discussion, had your dad been dependent, sorry, means here in this case, if the father of the assessee would have been dependent, because it has been said that the father is independent, not dependent. So anyways, you are out of 80DDB. Otherwise, you would have been eligible. But since condition is all should be dependent, here all whoever is noted here, spouse, children, parents, everybody should be dependent. So you are not eligible for 80DDB. Let us say it would have been given that father is dependent. Then what? Then you satisfy this condition. The next is payment qualifying for deduction, any amount actually paid for medical treatment of the diseases which are specified. And then you would have been eligible for a limit up to 1 lakh. So you are correct. Just one small difference, that since father is not dependent in this example, hence you are not eligible. Otherwise, it is really appreciated that you have thought of that extra point, that if I'm not getting full deduction here because of the common limit of 50,000, can I go and take deduction in 80DDB? Yes, you could have, had the father been dependent, one, and two, the medical treatment is for one of these specified diseases for which you would have taken a certificate from the respective specialist. So you are correct. And also here the limit would have been 1 lakh. So you would have been definitely getting the entire amount as deduction. Perfect. Excellent. See, this is the fun in studying, and especially a subject like tax, that also direct tax. Yes, it creates challenges equally at the same time because you have to match parallel things, but that is the beauty. So, else in this question, Mr. Suraj, that is done. So we have covered everything in this question. Nothing is left out. Yes. Fine. So that is all, students, from my side. This will be uploaded for your reference. Requesting you all to solve all sums from whatever topic you are solving, whatever MTP, RTP you are referring. Please solve, but don't look out for answers, because I have seen that people are mainly interested in getting the answer. But why answer? Because but an answer you'll get for this question now. But we are not going to learn that answer. So why? Instead, try to recall the provisions, try to analyze, and if not able to recall, go to the section. Go to the section means the notes, but don't go to the answer. Lokesh sir, 6,000. Can you explain once again? 6,000. Which point, Lokesh? 6,000 you are saying? Where is 6,000, Lokesh? Which point 6,000? Can you just? I don't find 6,000 here, beta. See, HG, last point. So where is 6,000? That's what I'm asking. See, 50,000 is a common limit. Out of which 33 is used here. So balance is 17. You have paid 20 for father. So you'll be eligible only up to 17 here. Acha, you are also saying, okay, he contributed 6,000. See, now this 6,000 which he has contributed towards the central government health scheme. Okay, you're talking about this. But for whom? For whom has he contributed the 6,000? So he has a question, ki, sir, what we do of this 6,000 which is given as contribution for central government health scheme? Now, if it is contributed for himself or spouse, then it will come here. So besides this 22, you will also add 6,000. So the total will become 28, out of which limit is 25. Then your deduction is, sorry, 25. But if this CGH is for parents, then it is not eligible because anyways the limit is also exhausted. So from the given language, it simply says he contributed 6,000. But for whom? So if I assume it is for himself, for his spouse and all, then besides this 22,000 which you have paid for Mediclaim, 6,000 is for CGHS. So now the total amount is 28, compare it with limit of 25. So you are eligible for 25 in the first bracket that belongs to self, spouse, children, dependent children. And in the second bracket for parents, you have utilized the whole 50,000 limit. So now your total deduction under 80D will be 75. Fine, Bida Lokesh? Yes. Perfect. See, Siddha, for buyback, there will be no STT paid, beta. Because STT is paid only when transaction happen through stock exchange. Buyback, the company is getting directly, na? So why there will be STT paid, beta? And anyways, from this year, for buyback, the rule is changed. For buyback, anyways, there is no income under capital gain. The entire amount received on buyback is going under the head other sources. So there is now no question of STT paid or not paid. And uh, in the head of capital, whatever was your cost, that will be allowed to you as deduction, but the amount you have received as buyback will be taken in other sources. So now the new computation which we discussed in the previous class also will be like this. Whatever amount you received against buyback, that entire amount is your other sources income, and whatever is the cost of acquisition is your capital head loss. Right, beta? Perfect, Siddha. Or you can simply go to the previous questions answer. You'll get the, if you have not understood this, because I skipped that because we did exactly the same sum in the previous class. So instead of that, this question, exactly the same sum. So I thought of going to a new example. So I skipped that, but we did in the previous class. Yes. So thank you all students. Thank you very much. It was a great fun for me discussing with you all with such great inputs, such alert students. So use this skills what you all have and study well, prepare well, firstly for your exams, then for your career, because this subject is a very big career option. So please prepare it thoroughly, but right now focus on your exams and you will be getting the best marks if you prepare with a proper approach, right? Gayatri is asking, sir, medical expenses for parents to be made by cash or by other mode. See, in this whole section, only this preventive health checkup is allowed in cash. So this amount, what you asked, the medical expenditure has to be paid in a mode otherwise than cash. Only the preventive health checkup, that is that I think 5,000 is the total limit for preventive health checkup. For that only cash is allowed, but for other payments, cash will not be allowed. Fine. So if you're asking for the medical expenses, it should be through other than cash medium only. Right, beta? Perfect. Great. So that's it all from my side, students. Study well, prepare well for exams, and let us be in touch. My blessings are always there with you all, and we'll connect again for the next revision class. Until then, prepare well and prepare in the same manner how I explained the previous and this current session, that is by solving sums and without going to the answers. Answers are not to be seen at all. Use this opportunity to go back to the module to revise the provisions. Thank you. Thank you very much. Yes, yes, sir. Yes, Bhargav. Bye bye.